Yeah, I guess you're right. So anyway, that's, so I've met a lot of important people, and I've learned. I read a lot of books. Read. If you want to get smart, read. People that write books are smarter than people that don't write books. Because it takes a lot of effort to write a book. It took me 1.5 years to write this book. I woke up every morning at 5 o'clock in the morning, because I was a mortgage broker before that. When I was, for 2.5 years when the mortgage broker was back, 5 to 7, 1.5 years. I got up every morning and knocked it out. And I said, I will never, ever in 1,000,000 years do that again. I guess I'm changing. I have to share some new information with you. So anyway, so the trend is up. Case Shiller, this is the most popular home price provider. Home prices are up 5.3% year over year. This is the national index, not the Case Shiller 20, and it's back at its old peak. It just hit its peak. Case Shiller 20 cities, off of their 2000, from their 2006 peak bubble highs. The two cities right now that are the highest are Denver and Dallas, and I think they're in borderline bubbles. Borderline bubbles. The one city that I'm going to share with you that is in a bubble, hands down, and it's in California. You know what city that is? San Francisco. Absolutely. Do you subscribe to me? That's why you know the answers. Have you? What's your name? Marie. Huh? Oh, hi, Marie. Have we ever met before? Oh, before. I know I've got it right. I recognize you. Okay, but look. So, these down Denver and Dallas are kicking ass. Okay, off their highs. The Las Vegas market, the Phoenix market, Miami market, they've risen like 50, 60, 70% off their lows, right? Off their lows, they're still at 50, 60%. That's a nice trend you can take advantage of. Compared, if you were unlucky enough to buy at the peak in Las Vegas, Phoenix, and Miami, you're down 35%, 28%, 23%. Tell me timing's not important. Tell me the buy and hold is the only way to roll. No, it's not. It's not. One of my chapters is Myths of Cash Flow Investing. People think cash flow can never change. Wow, read some books. Quit listening to guys that tell you can't change. You can change big. And what's also interesting about cash flow investing is one thing, two things. Everybody underestimates their expenses. Operating expenses. Tell me somebody that doesn't. I did when I was building. When I was developing, I was building 8 and 16-unit apartment houses, spec, and selling them. And my father-in-law at the time, my ex-father-in-law now, he owns, I just gave it to my kids, 2,000 units free and clear in San Diego County. Right. So they don't need any money. So I showed him my pro forma one day, and I showed these new buildings because I was selling them. I was doing really, really well. I was making $200,000 a year. That was back in the 1980s. That was a lot of money. And he looked at my pro forma and he said, after expenses, and including reserves, he said, I think I had 26%. And he said, you're low. I said, what should it be? Somebody that manages 2,000 apartments, for 20, 30 years, they probably have a good idea what the real numbers are, right? Said, if you include reserves, it should be 45%. The people I was selling to didn't know that. They were Buffalo too. But that's what they did. People underestimate. And when you get in a down market, do you think vacancy stays the same as it was before the bust, or goes up? It goes up. Do you think it? And so when your turnover goes up, you know what happens to your expenses? They go up. Yeah, there's a couple people I've talked to that made a lot of money in real estate, buying and selling apartments, and they told me privately, they go, Campbell, cash flow is one thing. That's okay. The big money's made with timing. Getting out of the way of bad market, getting into good markets and out of the way. Yeah, cash flow helps. That's the selling point, but that's not where the real money's made. 3 Case Shiller cities that are in bubbles. Okay, I mentioned San Francisco. Here's San Francisco, and here's Denver, and here's Dallas. San Francisco's like 15, 20% above the old peak. In the city, not the Bay Area, the city, housing prices went up 100% in 4 years. Is that a bubble? Yeah, it's a bubble. Right. I mean, any kid with a you know, high school understanding of statistics would go, yeah, that's a high standard deviation event, isn't it, Campbell? And go, yeah, exactly. But look at this. Why Dallas? Why Denver? Because you notice during the last boom, here was the national averages, Case-Shiller national average. Denver underperformed. Dallas underperformed. But look what they're doing now. They're way, because here's, I mean, off the bottom, they've way overperformed. So I think that they're vulnerable to a nastier downturn than the national averages when it comes. Housing affordability. Okay, about 4 months ago I said the city's in a bubble. And I showed you some evidence why. That they've gone up 100% in 4 years. Also, then I presented this. Okay, the boom and bust cycles of the San Francisco. The bus cycle started in 1991 when affordability in the Bay Area in San Francisco got between 10 and 15. That was the bus period. You know, back in the peak of the housing market, it got at 10. It's back at 10. Just more confirming evidence. All data, you guys. That's all I look at. Oh, it can't happen because blah, blah, blah. You know, high tech is, you know, they're really cooking now. You know, you can't go down. It's just going to keep getting more and more and more. Well, has anybody known what's, I follow the markets every day, the sectors. You know what's happening to tech stocks recently? Are they strong or are they weak? They're weak. Hey, look, they're vulnerable just like everything else. In my world, nothing is safe. Nothing is safe forever. It's safe for a period of time, then it's unsafe. And so the Bay Area, anybody that buys into the Bay Area right now, I can almost guarantee you the next 5 to 10 years that you will realize a 0 to negative return on your investment. Would Warren Buffett buy San Francisco real estate right now? He'd laugh. He's a value investor. He would laugh at you. Warren Buffett turns down 99 deals for every one he accepts. Are most people that selected? I'm that selected. I have a short-term trading system that I use in the stock market. Position trade them in the market 2 to 5 days. 2 to 5 days. I make about 1.5 to 2% a month. You know how? Yes. It took me 40 years to come up with the damn thing. You can learn something if you got a brain in you, and all by trial and error, all by making mistakes. That's it. This works, and so you just keep doing it. But it's all about, you're always buying the trend, and you're buying trade-offs against the trend. Super, super selective. I can go weeks without making any trades, and all of a sudden in a 2-week period, I can make 5 or 6 trades. But that's what you have to be. Most people aren't selective. Most people aren't patient. Commercial real estate. Anybody here own commercial real estate? Okay. Bubble. Clearly a bubble. Okay, here was the boom. Here was the boom. Peak. Dropped 40%. Now we're 26% above the old peak, 107% off the bottom. And you know what commercial property trades off of? Cap rates, right? Okay, and cap rates for a lot of properties, you know, especially a lot of nice areas, beautiful buildings, are they high or are they low? Low. You know why they're low? I mean, for a lot of retired people, everybody's chasing yield right now. Okay, let's say you've got $1 million, $1 million. And you all of a sudden, and so statistically, you're a wealthy person. I would bet less than 1% of all Americans have $1 million. But you have $1 million, you've been successful in your life, you have $1 million cash, and 10, 15, 20 years ago, you'd roll that into 1-2-year CDs, right, and make 4 or 5% a year, just with no risk, and make $40,000, $50,000 in addition to whatever pensions and else you have. Okay, that's a nice way to retire. Today, you know what you make? 1%. You make $833 a month. That's if you have $1 million. Well, that's not going to cut with $1 million. So a lot of these people have flooded into like REITs, private offerings for commercial, to at least get 3 or 4%. I mean, historically, is that the norm for a commercial property? No, it's not even close. That's as risky as anything. And so now that what's started changing recently that was going to affect those cap rates? Interest rates. This young lady here can tell you, about 4 months ago, did I write about something? I think the interest rate market has changed, and we could be at or near the lows, and showed evidence why. And I mean, look, it's all statistics. All statistics. Things always go too far in one direction, and there's a way of measuring how far they go in any direction statistically. And then they can go too far the other way. And so you sell here, you buy here. So anyway, interest rates are rising. And I get asked all the time, how high are they going up? I don't have a friggin' clue. I'll tell you where they're going long term. They're going back to normal. Are we anywhere close to normal now? No. You know when I know they're going back to normal? Because everything in life goes back to normal. That's the way the world works. And you just have to accept that. And you can measure that with standard deviation events. That's kind of complicated stuff, but I'm just showing you this, that it's all driven by numbers. I live in a world of numbers. Am I all numbers? Right. Always. People ask me, where's the market going to be a year from now? I am not a crystal ball guy. I don't know. But you follow trends, and the trends will take you there. Like picking highs and projecting highs. Hell, even the best weather forecaster in the world can only forecast the weather accurately out 3 days. And somebody's going to tell you what the weather's like 6 months from now, or a year from now, or what the market's going to be like? Anybody know who Ray Dalio is? Hedge fund manager. He runs, what was that? BlackRock, biggest hedge fund in the country. Really super, super smart guy. Otherwise, he wouldn't be running $200 billion worth of money. You know what he said? He said, if Trump gets elected president, the stock market's going to drop 10%. There's a prediction for you. High IQ individual. Was he right? He could have been more wrong. So if guys like Dalio can't predict the future, who the hell can? You can't. That's the key. You can't. You don't know what's going to happen tomorrow. I don't know what's going to happen tomorrow. And nobody else knows what's going to happen tomorrow. So what's the default? You follow trends. It's the best solution. It's the only solution. I mean, there's a few guys that have an intuitive sense, in addition to following trends, but they're rare. So anyway, commercial's a bust. It's going to go bust. Anybody, I mean, now's the time to sell. Especially if you own commercial property in the city right now, I bet you it's selling at a 2.5% cap rate. And I bet you when this thing's all over, it goes to 6. What's that going to do to values? I mean, it's amazing. It's amazing how history repeats itself. If you want to predict the future, study the past. You've got to read books. Read books on economic history. Everything cycles in, cycles out. Nothing's ever new. It has a slight variation. On a national basis, I'm going to show you the trend indicators I follow and show you why the trend is still up. First, I have to tell you, my book presented 5 key indicators to follow. If you follow them carefully with good data, you will know what direction the market is going with an 85 to 90% accuracy rate. And that has a 35-year track record to back it up. Those 5 indicators are as follows: existing home sales, new home building permits, loan defaults, mortgage defaults, foreclosure sales, and interest rates. I've gotten so good at this. I've been doing it for 15 years. You could tell me, just show me what these key indicators are doing on a year-over-year basis. Don't even show me what the city is. I don't care what the city is, and I'll tell you what the trend is. Because it's that accurate. It doesn't matter what the city is. But you follow those key indicators, and that's what I'm going to be presenting to you right now. This is not one of them, interestingly, but this is something I've come up with, I've discovered in the last 15, 14 years. Supply of homes for sale. Supply of homes, anytime this number is below 6, that means it's a seller's market. If it's above 6, it's a buyer's market. So it rose above 6 in early 2006, telling you the market changed from a seller's market to a buyer's market. Was that a good time to get out of the market? Perfect. By the way, I'm a very hard individual to impress. You show me the data, I've got your ear. But if you show me a bunch of crap, I'll be polite, kinda. I'll say, this doesn't mean anything. But look, okay, back here, it fell back below the 6 line in early 2012. Was that a good time to buy? That's why it got my attention. So it's a good indicator to follow. Right now it's at 4.5, which is clearly below 6, and it's down from 4.8 months a year ago. Everything, all my trend indicators measure what's happening today from what's happening a year ago. With real estate, you want to slow everything down. Because a lot of headlines are telling you, oh my God, the housing market is about to go bust. You know, notice the defaults, according to CoreLogic, increased by 24.3% from August 2016 through September 2016. Does that mean anything? No. Well, you know what that does? That sure sells a lot of newspapers, doesn't it? Holy crap! The market's coming apart. It means nothing. That's noise. When you look at things on year-to-year basis, ladies and gentlemen, that's the signal. Pay attention to the signal, not the noise. U.S. housing supply shortage. Look at this. This is really interesting, and I can't explain this either. U.S. existing homes for sale as a percentage of the U.S. population. Right now it's at 0.54%. It's never been that low. So how do you explain it? The only way I can explain that, I mean, that shows you that we have there's more demand than houses for sale. My idea of it is that nationally, there's still something like 12, 13, 15% of homes are still underwater. Does that keep those homes from hitting the market? Because most people don't want to ruin their credit rating, and most people aren't going to come up with the difference. Hell, in California, 8% of the homes with a mortgage are still underwater. 8%. You know how far housing prices in California fell from the peak of the market in 2006 until they hit bottom in like 2011? 50%. 50%. So whether it's real estate or stocks, and there's lots of opportunities in other investment areas, especially when one's not doing well. So you got to move your money.